When the market is moving in a clean uptrend and price keeps advancing, it consistently respects demand zones and breaks structure to the upside. Put simply, in classical terms, it prints higher highs and higher lows. Every time a structural level is broken, a fresh demand zone is automatically formed. This break of structure is only considered valid when a candle clearly breaks through and closes above the level. While a wick extending above the high shows that buyers managed to push price higher, it also signals an immediate rejection back into the range. This behavior often looks like a liquidity grab, where stop losses are triggered from traders who entered short after the prior rejection. If price produces another break with a strong full-bodied candle, this confirms a valid breakout. At that moment, we can define this level as the most recent high or low. As long as price holds above this area, the bullish bias remains intact and our focus stays on buy opportunities. However, if a clear reversal pattern appears, it may be reasonable to look for a short trade targeting this demand zone, since it still functions as solid support. A change in character takes place when price breaks and closes below this low. This indicates that buyer control is being challenged and the market may be shifting structure into a potential downtrend. The same logic applies in a bearish environment. When the market is in a clean downtrend and price keeps pushing lower, it respects supply zones and breaks structure to the downside. In other words, it forms lower lows and lower highs. Each time a structural level is broken to the downside, a new supply zone is automatically created. As long as price stays below this swing high, the downtrend remains valid, and our interest is strictly on selling opportunities. Here is an example. This shows the recent price action of the euro-dollar on the 1-hour chart. You can observe how price respects lower highs and repeatedly breaks structure to the downside, forming a textbook downtrend. Structure levels, swing highs and lows, and potential trade ideas are all clearly visible. If you study a chart and struggle to determine who is in control, it is often better to skip that pair. The difficulty is that markets rarely move in such a perfect way. In less ideal trending conditions, price may break below higher lows and still continue upward, misleading traders into believing the uptrend has ended. These moves frequently occur to collect liquidity or to mitigate fair value gap zones. Hello and welcome back to another video here on the ComLucro channel. Today, we focus on imperfect trending markets and how to stay aligned with direction even when price action becomes unclear. You will learn how to distinguish between major and minor swings within market structure, so you are not trapped by false reversals. We also explain how liquidity sweeps and fair value gap mitigation fit into this picture and why they frequently appear in these conditions. These concepts build a clear decision-making framework that helps you stay aligned with real price behavior, improve consistency, and trade in harmony with liquidity and market structure. So if you like this kind of video, please like, subscribe, and turn on notifications. And join the ComLucro community to support the channel and keep improving as a trader. Let us get started. Here is an example of how an imperfect trending market can appear. At first glance, price may look messy and directionless, but in this video, we will show you a method that turns this unclear chart into a readable and structured trend. The key idea is that in imperfect trends, your focus must stay on the overall structure instead of reacting to every small break. Many of these short-term reversals are temporary and often exist only to trigger stop losses or collect liquidity from retail traders. The first concept we will cover is how to separate major swings from minor swings. When does a swing high or swing low carry real importance, and when is it considered weak? In an uptrend, major swing lows are the critical zones where breaks of structure originate. This level represents the highest price recently reached after taking a previous high, meaning the starting point of that impulsive move defines our major low. A change of character happens when price breaks below this specific level. The remaining swing lows are classified as minor, and a break below them does not signal a genuine reversal. Now here is a key point to understand. A level can only be classified as a major swing after a valid break of structure has occurred. For example, this low cannot be defined as a major swing low until price delivers a confirmed break of structure. This level represents the highest price recently traded, and a break of structure is only valid when price clearly moves through it. As explained earlier, only after a valid break of structure can a level be labeled as a major swing. For that reason, this level becomes the major swing low, while the remaining ones are considered minor. A break below a minor swing low still signals a loss of bullish strength. If there is a strong justification, such as a reversal liquidity sweep, coming from a higher time frame key level, you may consider a short trade targeting the major swing low. This is because once price reaches this area, supply and demand come into conflict, and we often anticipate a reaction when price taps into this major low. Still, trading against the primary trend carries higher risk, as it increases the probability of being stopped out, essentially moving against the flow of the market. Now let us review the bearish case. The ability to separate major swings from minor ones allows you to correctly define market direction and identify real reversals. After price breaks the lowest recently traded level, the starting point of that impulsive move becomes our major high. On the Euro-Dollar 1-hour chart, we can observe 1, 2, and 3 moves breaking below this low, establishing a trend. The origin of this move is defined as the major high. As long as price stays below this level, the market remains in a downtrend. Let us continue the process of identifying major and minor swings. When price breaks through and forms a new low, we label the level where that break of structure started as the new major swing. If price only wicks with one candle below the recent low, this is not a valid break of structure and is therefore classified as a minor swing. A move above a minor swing does not signal a change in character. A real reversal only occurs when price breaks above the major high. We keep marking major and minor swing highs until a valid change of character appears, confirming a potential reversal and shifting our directional bias to bearish. In this example, we have a change of character defined by 2 clear wicks breaking above the last major swing high. However, it is important to emphasize that a change of character is only considered valid when either 2 or more wicks clearly exceed that level, or when a candle decisively closes beyond it. Then a break of structure must occur after this condition is met, confirming that the previous bearish structure has been invalidated. Another factor that strengthens the validity of a change of character is when the move is strong enough to break through the last 2 swings, not just one. If this does not happen, as in this case, the change of character is classified as a fake change of character. This was the first criterion for defining a major swing, the origin of a break of structure. There are 2 additional criteria that help us identify major swings and confirm market direction. The second criterion is the fair value gap. A bullish fair value gap represents a buy-side imbalance, where buying pressure clearly exceeds selling pressure, often linked to institutional activity. The demand zone that generates this gap becomes more significant, and we expect a reaction when price revisits this area from an imbalance perspective. Demand zones that include fair value gaps are treated as major swings, while those without imbalances are considered minor. When price breaks below a major swing that created an imbalance, it signals a meaningful shift in momentum and points to a potential reversal. The same concept applies to bearish scenarios. Here we have 3 price examples. The first one shows neither a break of structure nor an imbalance, so it is classified as a minor swing. A break below this level does not signal a change in momentum or a reversal. The second example is the origin of the breakout, but does not include an imbalance. For that reason, it is considered a major swing, but only with 1 star. The third example is both the origin of the breakout and the source of an imbalance, which makes it a major swing with 2 stars. Up to this point, we have covered 2 criteria that define a swing point as important and major. Before moving into the third and final criterion, let us examine a trading idea. Here, we have a major swing low that initiated this break of structure. we also see another swing that created an imbalance. This level is classified as a strong swing even though it did not cause a breakout. When price revisits this level, we expect a rejection. However, if price breaks below it, that signals bearish momentum. This situation often appears when price taps into a key level from a higher time frame. At this point, we can look for short entries inside this inverse fair value gap area, targeting the major swing low, since it continues to act as strong support for price. Now let us move to the third and final criterion that helps us define a major swing: the depth of the retracement. Consider this example of an upward impulsive leg. After the impulse, price forms two retracement candles, but this pullback does not reach the 38.2% Fibonacci retracement level. Because this minimum retracement is not achieved, this correction is considered invalid. As a result, this pullback does not qualify as a true swing. Instead of being treated as a completed move followed by a correction, the next push higher is considered a continuation of the same impulsive leg. In other words, both pushes are read as a single impulsive movement rather than two separate swings. This leads us to an important rule in the ComLucro framework. For a retracement to define a valid swing and separate impulsive legs, it must reach at least the 38.2% Fibonacci retracement of the prior impulse. If this condition is not met, the move is treated as one continuous impulse and cannot be used to define a major swing. Now take a look at these examples. In the first case, none of the criteria we covered are present, so this level is classified as a minor swing. In the second case, we have a break of structure and a valid retracement, but no imbalance. For that reason, it is labeled as a major swing with 2 out of 3 criteria met. It is important to note that the retracement reaches at least the 38.2% level, which makes the swing valid. In the next example, we see an imbalance and a valid retracement to 38.2% or more, but there is no valid break of structure, so this is also considered a major swing with 2 stars. In the final example, the swing has created an imbalance, broken structure, and shown a proper retracement. This makes it a major swing with 3 stars. Breaking below this low confirms a valid change of character, signaling a true shift in market direction and momentum, or however you prefer to define it. Up to this point, we have shown how to identify major swings and valid changes of character, and why not every break signals a real reversal. Liquidity sweeps and fair value gap mitigation can invalidate a change of character. When a major swing sits in a liquidity area, a break may only be a stop hunt, with smart money sweeping liquidity before continuing the trend. The same applies to fair value gaps. Price often breaks structure only to rebalance an imbalance, not to reverse. Before we wrap up, take a moment to reflect on why understanding structure really matters, especially in imperfect trending markets. Concepts like major and minor swings, fake breaks of structure, and false changes of character directly affect how you read direction and avoid being misled by liquidity-driven moves. The clearer your understanding of how price reacts around structure, liquidity, and imbalances, the easier it becomes to stay patient and aligned with the true trend. But recognizing structure alone is not enough. To apply these concepts consistently, you must also understand how liquidity behaves inside market structure. That is why, before we finish, we want to show you a short clip from our Smart Money Concepts course. In this segment, you will see how internal and external liquidity explain fake changes of character, fake breaks of structure, and why price often violates structure before continuing. Let us take a look. Within the concept of liquidity zones, there are 2 main types: internal liquidity and external liquidity. Internal liquidity, also known as fair value gaps, FVG, refers to areas within the current price structure. These gaps occur when there is a significant difference between the closing of one candle and the opening of the next, resulting in a liquidity void. These areas are important because large market players tend to fill these gaps, creating trading opportunities to capture movements back to fair value. External liquidity refers to zones outside the current price structure, usually found at previous swing highs and lows. These are the areas where many retail traders place their stop-loss orders. For instance, at a swing high, stop losses often sit just above the level, creating a pool of liquidity that large market participants may target before reversing price direction. In practice, price tends to move between buy-side and sell-side liquidity, seeking these clusters of orders to generate movement and volatility. Recognizing how liquidity flows between these zones helps traders anticipate where price might react and refine their entries, exits, and overall strategy. That clip reinforces a key idea. Consistency does not come from predicting every swing, but from understanding context. Traders who recognize fake choches, fake BOS, and liquidity grabs and still follow their plan with discipline are the ones who turn market structure concepts into stable, long-term performance. Please also remember that our mission here on the ComLucro channel is to give traders the clarity and confidence they need to make smarter decisions in the market. Every video, every course, and every piece of content we create has one clear purpose: to deliver practical, easy-to-apply knowledge that helps you grow step by step as a trader. Here on the channel, you'll find complete courses on smart money concepts, technical analysis for day traders, and trading psychology. Because trading isn't just about charts, it's also about mindset, discipline, and risk management. We also share lessons and insights from some of the most respected names in trading, professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, Larry Williams, and many others whose experience has shaped the way we understand the markets today. If you enjoyed this video and found it helpful, please give it a like. It really helps more traders discover our content. And don't forget to subscribe and turn on notifications so you never miss our latest insights and strategies. If you'd like to go even deeper and access exclusive content, early video releases, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support our work and a smart investment in your own growth as a trader. Thanks for watching, and I'll see you in the next video.